All right, we're going to turn things over to Tyler Orton with business in Vancouver. We'll look at some of the news making business headlines. And the big one today, of course, the U.S. walking away from the Paris Climate Accord, one of only, I think, 3 nations in the world that is doing this.
Yeah, this is not good news for Canadians concerned both about the environment as well as the economy, Sonia. Look, when Ottawa agreed to this national carbon pricing plan that would see carbon prices of $50 per ton by 2022, it did so with the expectation it would have a partner committed to the program down in the United States. Now, the concern is that Canadian companies are going to be at a competitive disadvantage versus their counterparts south of the border. And so what does this mean for the future of the oil industry in Canada? The surprising thing is energy stocks, they actually went up yesterday. Essentially, everybody had built in all their low expectations of Trump back in November when energy stocks in Canada actually did decline. So that's already been built into it. But there could be calls for tax breaks for the oil and gas industry. But other thing that's very notable here is that we could see less investment coming to Canada when investors are looking at the United States and seeing jurisdictions right there aren't going to be hamstrung by this so-called carbon tax as well. One last thing that's important here is that Canadian power producers may be losing existing and future sales when it comes to exporting clean energy to the United States as well, because Trump has vowed to scrap the Clean Power program too.
All right, but Tyler, maybe the flip side of that coin might be more investment in green and other clean energy technologies in Canada as opposed to the U.S.?
I would definitely say that that's going to be a big factor going forward. I was speaking to, say, the chief financial officer of Ballard Power just a few days ago, and he's saying that the market for clean energy, it's been behind a big turnaround for his particular company. And we'll be seeing a lot of that from, say, the Chinese market, looking at the Canadian innovations that are out here. I definitely see a big potential, but I don't see it being able to close the gap in the near future, though. That's the big concern.
Interesting. All right. Now, closer to home, Lululemon, Vancouver-based company, they're closing a bunch of their stores, and these are the BIV chain.
Yeah, you know, it's been a brutal year for brick and mortar shops in all the retail sector. And as you said, BIV is going to be no exception here. They're closing 40 of 55 stores across the globe that's under this children's wear brand, BIV. So another 7, they're going to be rebranded as Lululemon shops. So that's going to leave only 8 BIV shops across the entire globe if people want to get children's activewear. And this is part of an effort to restructure this brand. There's going to be focusing more on e-commerce because essentially analysts out there said yesterday after this news came out that there's just maybe not enough demand for children's activewear. And, well, Lululemon, they're going to take a loss on this one. It's going to be a $50 to $60 million U.S. loss. The one good news, though, is shares are actually up yesterday, and I just checked a few moments ago, they're actually up 12% versus the closing price yesterday. It's because Lululemon released its quarterly financial results along with this bad news, and their sales are actually at $565 million U.S. in the second quarter. That's above expectations, about $535 million U.S. So good news, bad news for Lululemon at this point.
Tyler Orton with Business in Vancouver. Thanks, Tyler.
Thank you, Sonia.